right, good morning, everybody. As everyone is connecting to audio, we'll let everyone get connected there. I see Carol. Hi, Carol.
Hi, Carol.
Hi, Carol.
I'll give just a second. I'll do some little intros and introduce our guest speakers. You don't want to hear from me today. You want to hear from Drew and Cindy and James. So I'll turn it over quickly. Let's let everyone get connected here. I got one more connecting, and then we'll get started. All right, looks like everyone is in. Good morning, everybody. It's 10:05. Thank you for joining this morning. This is a topic that we get a ton of questions on, so we really appreciate Butler Title helping us put this together, and Drew to take your time this morning to go through 1031 exchanges. It's something that, especially in the lending space, I know just enough about. I know I can do them, but that's about as far as my knowledge gets. So it's fantastic to dig in and get some more information. Just a little bit, if you are not currently a member of the FAMP, I would of course encourage you to do that. We spend a lot of time as an organization working for originators and lenders, being able to make this a more profitable and more easy to do industry in the state of Florida. So we would appreciate your support. Your $159 membership dues do a lot to help keep us engaged in Tallahassee, help us pay for our very good lobbyist that helps us get legislation passed. Recently, we were very involved with remote work legislation, insurance reform, condo reform. There's a new bill coming out to fix an issue with reverse mortgages and taxation in the state of Florida. So lots of things that we're involved in. We can't do without you. So please get involved. If you will, give us $200, $159 in membership dues, $40 to our state PAC to help us support legislators that support our industry. You can get signed up and all that stuff on ourfmp.org. That's enough about me. I'm going to go ahead and introduce James Avello. I hope I'm saying that all right, with Butler Title, the owner of Butler Title, and Cindy Zucker, who does business development for Butler Title as well. Like I said, kind enough to put this all together for us. I'll just turn it over to you guys.
Thanks, Mike. Good morning, everyone. Thank you for logging in. My name is James Avello. I'm a real estate attorney, also the owner of Butler Title. Happy to be one of the sponsors here this morning. Just a quick background on me and Butler. Obviously, everybody here knows what a title company does. What we offer that's unique in the industry, and Drew and some others can attest to this, we offer what's called the Butler rebate on every closing, whether it's a purchase or a refinance. Some of you or many of you may have heard of that term. It's essentially an offer that we give to all of our clients, 10% of the title insurance premium back to the client in the form of a credit on the closing statement. So, of course, title insurance is a state regulated rate, and the cost of that policy that you pay at closing is determined by the purchase price and loan amount of the property. So doesn't matter if you're closing your transaction with another real estate attorney or a title company, we all have to charge the state promulgated rate. But what we do is whatever that rate policy premium ends up being, simple math, if it's $1,000 policy, we're going to give $100 or 10% of that amount back to our borrower to help reduce cash to close and make the closing a little bit more affordable. So it's a nice incentive that we offer our lender partners for their clients and of course our realtors as well. And specifically, for the lending partners that we have, it helps make your loan estimates a lot more competitive. We start getting into the bigger loan amounts. I'm often saving people $500, $600, $700, $800 on a refi. Cindy actually has a cash out refi, 7-figure cash out refi coming in today, and we're going to save that borrower probably close to $1,000 in rebate. And of course, when that loan officer or mortgage broker is sending out a loan estimate and having that borrower shop him or her against, Quicken, Rocket, you name it, and they don't have that type of rebate on the loan estimate, our cash to close is always going to come back in much more competitive because of that rebate. I don't know any other companies that do it on a routine basis. We do it on every deal. You don't have to qualify. You don't have to ask for it. We automatically have it baked into our software and into all of our closing statements. So it's a nice incentive. Always happy to chat further about that. I've been an attorney for almost 15 years down here in Broward County, born and raised. Opened up the company about 6 years ago almost, and we've done almost 5,000 closings in that time. and we've given away a hair under $1 million in rebate. So a substantial amount of money to our clients. It's been a nice way to help pay it forward. The more deals we get, the more money we give away, and it seems to be a win-win. So again, always happy to share more info, chat about that and the specifics and how that works. Again, Cindy Zucker, who's on the call, I want to pass it over to her. She works for me at business development. She can introduce herself, and then we'll pass it over to Drew, our speaker, who's I'll personally attest to this real quick. Great. I've worked with quite a few 1031 companies, intermediaries. Drew's excellent, very knowledgeable. I've referred him to multiple clients, some high net worth clients who are super picky and demanding, and they've personally called me and said Drew is very gracious with his time, super knowledgeable, knew more than my CPA did actually about some of the nuances about 1031. So always happy to refer him. Highly recommend any of your questions about 1031s, utilize Drew. And I say that from personal experience. But anyway, let me pass it over to Cindy real quick. And thanks again for logging in, guys. Cindy, you're on mute, by the way.
Good morning, everyone. Thank you so much for attending today's 1031 Exchange with Drew Monaghan. I am a proud affiliate member of FAMP. I work in the title space for Butler Title. I have an excellent team, and I am always available to each and every one of you to provide additional education, whether it's lunch and learns or continuing education to provide value to you and your clients. So thank you once again. And Drew, it's your turn. Take it away. Thank you very much.
Awesome. Thank you, everybody. Appreciate the kind words, James. Cindy, it's been great working with you as well. And Mike, appreciate the opportunity today. The first thing I would say is I can't thank you enough for your time committed to this. One of our biggest competitors is ignorance. People just don't know about 1031 exchanges. They assume somebody else knows, or it's a CPA question or a tax question, whatever. And it's funny because sometimes we'll get somebody in a panic because they're trying to do an exchange last minute because they just found out about it. So the fact that you're on the call today and spending the time on this is huge. That actually reduces anxiety and actually gives clients a better chance to make better planning on getting the most out of the exchange. And as we get into it, you'll start to see what I'm talking about there. There's a lot of strategies, and it's simple, but there's a lot of strategies that can be taken advantage of when you have more time to plan. Okay. So let me start off by this. If I was to ask you what a 1031 is, how would you answer that question? If you want to mute yourself or hit up on the chat, what would be your way of describing that to somebody? If somebody out of the blue just asked you that question, anybody?
I would say it's taking the profits from a sale, and instead of paying taxes on it, rolling it into your next deal and actually building upward instead of, and not paying taxes for now or ever.
Got it. Have you actually, thank you. That's a great answer. Have you ever supplied that or answered that to a client?
Yeah.
And what was their reaction when you said that?
I think most people that I have conversations with this about, they initiate the conversation just because of the space I'm in, mostly residential, and they kind of know about it a little bit already. Fair
enough. So I appreciate that. So, and that's part of it. A lot of times we have people that don't know about it. So I want you to consider thinking of it as a simple definition. You're not, if you want to, you can, but you don't have to be, a technical defined answer for somebody. If somebody asks you that, you might want to say, listen, it's like playing Monopoly for real. You ever heard of the game Monopoly? Okay, it's internationally known. Basically, you want to take something that somebody knows, connect it with something they don't know. And right away, when you hear that, there's an emotional response usually. Sometimes people are loving the game, other people hate the game, but it's an emotional attachment. And what I want them to do is get the sense of what this really is. What this is a deed swap. Okay, they're not doing you a favor, or the IRS isn't giving you a freebie. All right, it's basically taking a property used a certain way, exchange it for another one used the same way. Okay, it's been in the tax code since 1921, so it's not a loophole. It's not something that they're hoping you don't find out about or do too many of them, and they're going to shut it down. Now, every election cycle, there's a proposal to reduce or eliminate it, but it never goes anywhere because it affects too much of the population. It's not just one socioeconomic class. It's basically anybody, whether you have one property or many properties, really doesn't matter. Okay, so let's look at that deed swap concept. So if you sell a property for $1 million, right? And let's say it's net $1 million. When I say net, our world of net means net sale price, not net cash or net proceeds or net gain. Okay, we'll get to that later. But what we're talking about is if I sell it, my contract price is, let's say, 1.1. After closing costs, I net 1 million. I'm not doing any calculations. I'm just throwing a number to get your mind around it. So if I had $1 million property after my closing cost, and you had $1 million property, and we decide to swap deeds with each other, we go to James. James, here's the deal. We're just going to do a swap, right deed to deed. No money exchanged. No money touched the hands. Nobody pocketed any profit. There's nothing to tax. That's why this works. You're not creating a taxable event when you don't profit from a transaction. It's that simple, okay? So the challenge with that is, if you think about it, when you sell a property, the money's got to go somewhere. It can't be touched. If you receive receipt of that, whether you're buying a cup of coffee or selling a major building, as soon as you touch money, you pay tax. So that's one of the takeaways today, right? Touch money, pay tax. Touch a little, pay a little. So that's part of the strategies as well we'll get to later. But the point is, you can't touch money from a sale. So if you close on a property that you think is going to be good for a 1031, we'll just do that definition in a second, and you receive those funds, you touch money, it's too late. Nobody can untouch them or rework it. All right. So one of the other key factors is we have to be involved before anything closes. Somebody cannot close on a purchase or a sale and then say, oh, by the way, I want to throw that in my 1031 account. All right. It's too late. All right. So keep that in mind. All right. It's one of the takeaways. The other part of it is you don't have to do a direct swap. You don't have to find somebody with another $1 million property and swap with. You can sell to whoever and buy from whoever. It gives tremendous flexibility and creativity on how to repurpose your portfolio. So using the monopoly analogy for a second, if you think about it, you have 4 greenhouses, you swap for the hotel. It's one of the standard things in monopoly, right? That's an exchange. Okay, in the real world, if you sold 4 individual properties, you're going to get taxed on each one of those profits that you sell, if it's sold at a profit or a gain, actually, right? Some people think it is profit. And then it means you have less money to pull together to buy that hotel. In the real world, it could be a hotel, it could be a multifamily, it could be a triple net, commercial property, something higher density that produces income. All right. So in the real world, we're going to attach that. Monopoly is not going to deal with capital gains taxes. Maybe they do in the future, but it'd be way too complicated for the game. So in the real world, that means we have less money to invest if we have to touch money and pay tax on that. So this gives you the opportunity to put it in a process that you don't pay that, to what Yitzi said before. Here's part of it, though. So an intermediary comes in, like us. If you think of the name qualified intermediary, which is one of our names that we're known as, we're an intermediate between a sale and a purchase closing, a connection, if you will, a bridge between a sale and purchase, right? So they come in, one of our main roles is to set up an escrow account, just like you have an escrow account for a closing. We set up an escrow account for the sale proceeds after closing. So the proceeds have to come directly from that sale to us, and then we provide those funds to the purchase. All right. So if you guys known some of this before, just bear with me. I want to cover all of it, assuming you know nothing. Okay. And then we'll get into it. If you have any questions while I'm doing this, please do not hesitate to reach out. If it's too involved or advanced, then we might table it for another conversation, but I will get to it. All right. So think in that terms of not touching the money, right? The usage has to be for an investment property, which I'll cover in just a second. And you have to gauge us before anything closes. All right. So let's go back to the usage and money. So the money is very simple. We take the net sale price. That becomes what we call your target spend. Reinvest that money. If you reinvest, if your net is $1 million, reinvest $1 million, you can take 100% deferral of the taxes, right? The second part of this is the usage. It literally says in the first line of the tax code, it says properties, real property has a non-recognition of gain if it's exchanged for other property, real property used the same way. And the definition is this: investment or business use. Business use, very simply translated, means you're running a business out of it. The investment use is you're using it to make money. Okay, unless it's land, you don't have to do that, but you're not flipping it, you're not living in it, and it's not a second home. So that's part of the key factors that sometimes trip people up. Well, I use it 3 months a year. Not qualified. They have a limitation of 14 days or 10% of the rental period. So you could rent it for 300 days. You can personally use it for 30. All right. So the idea here is that the usage has to be used to make money and not flipping. Now, let me address flipping just for a second. Flipping is not bad. There's nothing wrong with it. Okay. However, it's treating real estate like inventory. And anytime you sell inventory, whether it's computers, phones, desks, or widgets, you have to pay tax on that. Doesn't matter how long you've owned it. It means that was the usage that you used it for. But let me give you a crazy example. Let's say Mike sells me his primary residence and it's in perfect condition because he's a great guy, right? He loves what he does, takes care of it. I put a tenant in the next day. Same property, nothing changed physically with the property. His usage was different than mine. I have a different tax treatment. Okay, so think of it like that. Now, you can't change usage on a whim either, though. If let's say you have a primary residence sale and you realize that that exemption of $500,000 if you're married, the first $500,000 of gains is not taxed. And you go, wait a minute, I made $1 million on that. That's going to mean $500,000 tax. You know what? I'm going to throw a tenant in there and call it an investment property because it is my investment. They won't let you do that. They won't let you change usage on a whim to get out of a tax bill. So we recommend seasoning. It's our term. It's not like a IRS says it, but if you think about it, they like time of using it to prove that that usage was valid for what you're trying to claim it for. So for example, if your primary residence, you've lived in it 2 out of the last 5 years, you can claim that exemption that I just mentioned. There's letter rulings that came out about 1031 usage where you convert it to a primary after 2 years of renting it. So we hear things like that from the IRS and we say, be conservative. If you've used it a certain way in 2 years or more, then you feel comfortable taking the advantage of that tax benefit if you've done that. So the takeaway here is if you use it for 2 years of renting it or more, you should be good to go. Now, the first benchmark is a year and a day, but because it goes from a short-term asset to a long-term, but just think longer is better. Because if you say this is an investment, if you submit this to the IRS or your team does, or your client's team does, you're telling the IRS that you believe this qualifies for an exchange because you checked all the boxes. You use the intermediary, the timing, the usage, the money, everything checks those boxes. But if let's say you own the property for 40 years before you sold it, you put the new one together and you bought this new property, you finished the exchange successfully, and 2 weeks later you put a for sale sign on it. You just killed the exchange if they audit you. Okay, so it's key to keep that balance on both sides way after we're done. So when we have sit down with the client, we go through this with them because I want them to understand what it means to them, what their options are, and specifically how it matches their goals. Okay. I just saw a question from Chris. Is there any different rules for vacant land? Great question. No. And the reason for that is because it's the code says real property exchange for real property. The type doesn't matter. So whether it's improved or not, residential or not, as long as the state that the property is in considers that asset real property, it's exchangeable for any other real property. Think monopoly, greenhouses to the hotel. Okay. Also, air rights could be real property. Minimal rights can be real property. Okay. A condo hotel is real property. A co-op is real property. A Delaware statutory trust is real property because that's how it's set up. An LLC could be real property if that's how it's designated with the tax provider, the tax advisor. So as long as it's real property, good to go. It's exchangeable. Make sure the usage is covered, and there you go. All right. Before I move on to the next, any questions on that? Chris, hold on a second. Chris,
Drew, just
yeah, go
Drew,
ahead.
sorry, I didn't mean to cut you
Yeah,
off. There are a couple of questions that have popped up in the chat log. I don't know if you see that.
Yeah, I just did. Thanks, James.
Sure.
Second question from Chris. So you can exchange land for apartment building? Yes. Does it have to stay the same? No. It's usage and money. As long as both of them are real property, usage and money is the case. So if the land is $1 million, the apartment building is $1 million or more, good to go. But what if it's less? What if the sale of that land is 900? I'm sorry, $1 million. And let's say the apartment building is 900. Could you still do it? The answer is yes. That 100,000 left over is taxable unless you put it into another purchase. Again, touch money, pay tax. And sometimes somebody wants money out of a closing, right? That happens. I want to use it for something else. So if you know that 100,000 is going to be taxable and you're okay with that because you talk to your advisor, you might have 100,000 write-off somewhere else, a capital asset loss or something. Okay. Or you just want the money and paying tax on 100 is better than paying tax on 500 if that was your gain, let's say. It's a calculated financial decision that makes sense. All right. The takeaway there is 1031s are not absolute. The more you leave on the table, the more you take, the more taxes you pay until it's not worth it anymore. So the key is it can do that. All right. Let's look at Mike's question. Can you roll the proceeds from one 1031 to multiple subsequent purchases? Yes. Again, monopoly the other way. Sell 4 by 1, sell 1 by 4, 2, 3, doesn't matter. For instance, sell property for 500K and use it for purchase to other properties. Yes, no problem. Okay. Well, when we get into the strategy, you see how critical it is to manage that, but it's definitely doable. Can you refinance shortly after the exchange, Gary? Yes, you can. We used to tell people years ago to wait 6 months after the exchange finishes. When we had a meeting up in DC years ago, and they happened to have 2 IRS attorneys there, they said, we don't see anything in the code that doesn't allow that. So the answer is yes, you can refinance as soon as the bank, the lender, everybody's ready, right? And I think the reason why is because when you refinance and pull money out, you're not creating a taxable event, are you? You're just pulling, you're creating an obligation against the property. So that's still on you. It stays with the property. So since we had there, let me address how mortgages affect 1031s. And this is a big one for everybody here. So hold on, wait. 2 more questions. Sorry. What's the time limit from sale to purchase? I'm going to get to that next, Jacqueline. And Chris, what is the seasoning requirements and debt financing role? How does that work? Not sure what you mean by that first question, Chris. Was the seasoning requirements for on the debt financing role? What do you mean by that? If you could qualify
Sorry,
that.
I just got my microphone working. I'll just make it easier.
No, it's okay. Yeah.
I was reading on the 1031s that you can exchange it for like kind, but also if there's financing on the property that you sold, it has to match the financing on the new property.
Yeah, that's what I thought you were going to say. Perfect timing. I'm going to address that right now.
Okay.
And this is where you can be very creative and avoid problems at the same time. All right. So from a lender's perspective. So let's take that same $1 million example, and let's say you had a $600,000 debt on that property at time of sale, closing. All right. So obviously the bank has to get paid at closing. It's a lien against the property. It's a mortgage that has to be paid. So let's go through that. Let's say the contract was $1.1 million. Closing costs were 100. Again, I'm not doing calculations, just throwing numbers. So the net sale price is $1 million, just to keep the numbers easy, right? Now, in the real world, it's never a whole, not never, but usually not a whole number like that. Sometimes it can be, but because closing costs are not whole numbers. But let's just call it, for the example, $1 million net. And there's a $600,000 loan on that property. So the closing happens, the bank gets paid the $600,000, the 400 net goes into the exchange account that we've set up. You with me so far, right? They still have a target spend of $1 million though. Okay, if they don't spend $1 million, everything less than that, remember, touch money is taxable. And yes, mortgage money is touched money if you don't reinvest it. People say to me, well, wait a minute, it's not my money, it's the bank's money. I said, well, you had all the financial benefits from that money, didn't you? Right? Because you had that loan, it got you that property and did whatever you did with it. It went up in value. That loan doesn't go anywhere. That's part of the value of it, right? So if you did back to the deed swap, let's say Mike and I swap properties again. I have $1 million property and he does too. And I say, okay, here we go. And Mike goes, well, wait a minute. I have to pay the $600,000 mortgage off. That's not even swap for me, is it? Because mine's free and clear, his isn't. So you got to keep that like kind is really about real property and the value at $1 million. So let's play that out. So on a 1031, to your point, Chris, they have to reinvest by they get a new mortgage for 600-ish, whatever's required to make up the difference. Okay. Or they bring cash or they get seller financing. But most people just get a mortgage. Okay. You had a mortgage on the sale, you replace it on the purchase. Now, one thing I will caution you, this is one we run into almost weekly. All right. Is that when you have a 1031 client, this is a big takeaway for you guys. Okay. And they come to you and say, yes, we want to use financing on this purchase, and make sure they tell you it's a 1031. You want to know the numbers are. If you ever have a question, you can call me. Okay. Don't waste your time until we establish this, because let me tell you, this happened in the real world. So let's use that same example of $1 million and $600,000 mortgage. They come to you and they're going to buy something for $1.2 million. All right. Let's just throw the number out. It's a little bit larger than the sale was. And you say, let's maximize the mortgage amount, minimize the cash outlay, which is typical on a mortgage, right? We want, as an investor, I want to minimize my cash outlay, right? To maximize the mortgage amount. So you're in that mode because that's what you do anyway, let's say, right? Or the investor definitely would do that. And you say, you know what, I'm going to put 20% or 30% down on that $1.2 million. I'm going to use 400,000, let's say. Well, let me say it a different way. Let's say we stayed $1 million to $1 million, right? And I'm going to put 300,000 down, leave 100,000 in exchange account. I'm still spending the $1 million. My mortgage amount goes to 700. I only use 300 of what that 400 is in the account. Even though you spent the $1 million on the purchase, which sounds like it qualified, you leave 100,000 in an exchange account, all 100,000 is taxable. Guys, think about that for a second. The example I was trying to bring up is where somebody buys more, thinking they spent more, but they still leave 1031 exchange funds in that account. You're going to be taxed on it. Now, you do not want to have that, nor do I want to have that conversation with a client. We had one about 2 months ago because nobody came to us and went over these numbers. So we didn't know until closing that they had a mortgage like that. When we found it on the settlement statement, I caught it because I reviewed it and I said, you know, you're leaving X dollars in that exchange account, right? Oh yeah, it's okay. We're spending more money. I said, well, you can't leave any money in the account. Remember, touch money, pay tax. It doesn't sound right, but I'm telling you that is exactly how it's looked at. So they put it towards another property or they pay tax on it, or they might be okay paying tax on it, but I don't want them to be surprised. Go ahead, Chris, you were saying?
A quick scenario, because this was the main thing I wanted to find out about. So
Yeah,
let's say you buy a property cash for $1 million, and then you refinance it along the way. And let's just say you take out 500,000 for the conversation.
Yep.
Now you go to sell it, you're selling it for 2 million. So you have that loan, but you're making a lot more money. If you refinance it in between the sale, could you maximize, putting less money down, or are you saying no matter what, once you refinance, that's considered touch money in the overall transaction? Like that doesn't negate you in any way. It's a little complicated the way I'm saying it, but I don't know if you understand what I'm asking.
I'm going to give it back to you. I think I got it. It's a great question, actually. So, because this real world stuff is what we got to deal with. Okay.
Right.
So let's say your scenario is 2 million sale price. All right. What you're thinking about is, I want you to think of it as a snapshot. What's going on at the time of closing? What's the value at the loan at the time of closing? What's the net sale price?
So that's what I'm saying. Let's say they bought it for $1 million, but they know they're going to sell it in an exchange a couple of years from now or whatever it is. So they decide to max out the loan and change that loan from 500 to, let's say, 1.5 million and take out the max value. And now they're selling it for 2, but they have a loan for 1.5.
So you got the answer already. Let's walk through it. That's a great question, like I said. So snapshot time of close, net sale price 2 million. Let's say it's net after closing costs is 2.
Right.
Loan payoff $1.5 million. You have a cash component, debt component. You got to spend both. So now they have 500 cash goes in the exchange account. The loan gets paid off. They still got to replace it though, either with a new loan, cash, or they pay tax on it. And with those kind of ratios, they probably killed the exchange.
Okay.
You're not going to invest enough. If you're only going to invest the cash in that scenario, unless your cost base is less than 500.
So that's what I'm saying. So you can't take that 500 and then go put that down on another $2 million building and mirror the 1.5 million in debt. That wouldn't work because you pulled out the 1.5.
No, you would get a new loan for 1.5.
Right. So would that satisfy the exchange in that scenario?
Absolutely. Yeah.
Okay. So
go ahead.
So that is a good strategy then to max out the loan value, because you don't pay income on the loan value, and then they could use that for other things. And then when they sell the building, they effectively pay it off, but they have the loan proceeds as non-touch money at that point.
That's correct, because it's part of the net sale price that gets reinvested into the purchase.
Okay. And then so it's in your interest to max out and have the least amount of cash if you're going to buy the same purchase price and have the same loan, because then effectively you're doing an even swap and you got to keep your loan money on the side.
Right. And let me add to something else with that. Okay. Even if the loan amounts, interest rates are 8 or 9% in some of these loans, maybe 10% in some loans, right? Somebody has said to me, well, because the rates are so high in mortgages, I'll just pay the taxes. And I stopped them and I said, well, let's run the numbers on that real quick.
Right.
Right. What's the cost of the taxes? The cost of the tax is either 15 or 20%. Okay. So right away, the taxes are more than the loan amount, loan interest. And that usually stops people to think if they haven't thought of it already. Right. So even though the loan interest rates have been higher, it's still a benefit to do this because, again, you're saving the 15 or 20%. In some cases, in some states with the state gains tax, they might be 35% in taxes. So right now, even if it's a 10% interest rate on the loan, for whatever reason, it's still a savings. So what do you want to do? Do you want to pay the mortgage or you want to pay the taxes? Paying the mortgage is less, plus you keep the income coming in. Another takeaway for you guys is understand when we do 1031s, we're maintaining a quadruple compounding of their money. Let's walk through that a second, right? Appreciation stays intact and continues most of the time, usually over history, yes. Depreciation schedule continues. So depreciating the value every year, getting the tax credit, that continues with the 1031. It all rolls into the next property. And if they're 10 years in, then it goes to 11, 12 years, keeps going, all right? So that's the first two. Cash flow, obviously income, unless it's land, all right? And the fourth one is time value of money. If you put off paying taxes in future dollars, you've already saved money because of inflation. Today's dollars are worth more than future dollars. A loaf of bread isn't 25 cents anymore, okay? So think in terms of that. When I talk to this way with a client, we keep them focused on enhancing and improving their portfolio. That's the real benefit of a 1031. It's not about getting out of taxes. That's part of it. That's delaying the taxes, either forever, they never pay it, or delay it for 20, 30 years until they finally cash out and don't want to do real estate anymore. But even at that point, I still encourage them to stay in real estate because it's producing income. That's why you have real estate. It's not just sitting there crossing your fingers, right? So that's kind of the concept there. Chris, you get to go on that part of it, right?
Last question, I'm done on this topic. So is there any seasoning requirement on that loan? So can you take it out at any point? Because I know you have to come to you guys before you even sell. Do you have to have the loan in play for a certain amount of time before you go to enact the exchange, or it doesn't matter?
Yes and no. I mean, yes, because the exchange only has a limited time, which I'm going to get to in a second. And I actually recommend that clients sell and buy at the same time. Okay, let's get into it now. So, and we have another question, Gary, before we go on to that. Can you split the loan in different properties? Yes. I had a customer one time, give you an example, just throw 500 out there. Let's say they netted 500 on a sale and they bought 5 properties at 200,000 each, put 100,000 down on each, finance the difference. They just doubled their portfolio. And I told the client at the time, I didn't know what he was doing long-term because we didn't have that conversation, but I said, after the second purchase, the exchange could be over. It could have been over, 2.5 purchases at 200,000. But he said, no, I want to maximize because the interest rates were low. I want to maximize and expand my portfolio. I mean, think about that. What a great benefit for doing the exchange and using the lending part of that as an enhancement. Okay, so that's what I want you guys thinking about. It's doing what you're already doing, right? And adding creativity enhancement based on what they're trying to do, helping them get their goals, which is what you're doing anyway. This just adds another component to it. All right. So let me get to the one last question. You'd see with syndication, if the sponsor pays off, uses new LPs next purchase, does the exchange benefit or go to GP only? So I will tell you that the taxpayer has to stay the same from the sale to the buy. If you do a syndication or anytime you have a partnership where there's one entity on title, okay, whether it's a partnership, a trust, an LLC, an S Corp, C Corp, hopefully not a C Corp, but whatever, okay? It's a concept called vesting. The taxpayer of the sale has to be the taxpayer of the buy. If you think about it, it does make sense, but it can get complicated based on what people are trying to do. So let's say the taxpayer of the sale is an LLC or a corporation, and they're filing a tax return. So that entity is on the hook for the taxes, right? Because they sell at a profit or a gain, actually, right? So if they don't do the exchange, they're on the taxes, on paying tax on that. Yes, it rolls into the K1s for the individual members, but the entity is on the hook that has to handle that, right? So if you turn around and do the exchange, that entity also has to be the buyer. So we run into this. I run into just definitely every week where you have a multi-member LLC and the partners want to split. For whatever reason, doesn't matter. They could have planned it. They could have an issue. It really doesn't matter the reason, but they want to dissolve the LLC and say, wait a minute, I'm going to take my share, my membership interest, X percent, whatever it is, and I'm going to go buy something, do my own exchange. They can't do that because they're not the owner of the property, the LLC is, or the corporation is, or whatever the entity is. So they either do a tenant common transfer, preferably, again, with seasoning 2 years before the sale, where they drop off of membership interest, exchange membership interest to a title interest as tenants in common, and then season that usage with these new owners for at least a year, preferably 2, okay? Then do the exchange. But most times, by the time we're involved, they already want to sell. So if that's the case, then I recommend they keep the LLC intact, put together a management agreement that says that each party is going to buy, the LLC will buy a property for each party relative to their share. They're going to get all the risk and benefits of that for 2 years, and then they dissolve it. Sometimes that doesn't work. They don't want to wait 2 years. I had one the other day. They don't want to wait 2 years. It usually can kill the exchange. Or if one partner doesn't want to buy real estate, for example. So when you get into those kind of situations, we'll have a conversation, walk through the options. We have no skin in that game, neither does the IRS. I want to educate them on what options work for them, and then they make the decision. All right. Let me get into the timing so we don't run out of time, and then we'll get to this other question from Mike. So the timing is this. When you close on the sale, the closing date, that date on that settlement statement, not the disbursement date, but the actual closing date starts the clock. You have 180 calendar days, holidays included, to close on whatever you're going to buy. Not intend to close, close. The deed can be filed later, but that closing date on that settlement statement is what they're going to watch. So if that 180th day falls on a holiday, you don't have 180. It doesn't go forward like a tax return. It goes to last business day prior. So let's say 4th of July is your 180th day, and that's on a Monday. Actually, the Friday before that would be your last day to close. Okay, we don't usually get that far, but sometimes it happens. All right, but the first 45 days of the 180 is the most critical part of that. And that's called the identification period. We call it the shopping period. You only have 45 days to figure out what you're going to buy. You have to give us a list. We give you the form. It's a one-page. You put addresses on that page. And then from day 46 to 180, we're in closing mode. You can't shop anymore. Can't change the list anymore. You're closing what's on that list, and you're waiting till the 180th day to get funds back if you put something that you don't want to close on. So when I said before, managing that part of that is really the critical part of this, which we usually spend a lot of time with the realtors on this, because that's right in their process of closing and getting properties ready to negotiate and stuff. But just so you know, to Chris's point earlier, if the lender, if you know that the package and the underwriter and your whole process needs 30 days or 60 days to get it done, you need to be in contact with them as early as possible, right? So you hit in sync with those deadlines. Because think about it, if they're selling and buying at the same time, they're trying to match the sales cycle with the purchase cycle. And if the purchase cycle involves a loan, and for some reason the loan is particularly difficult, you got to be part of that conversation early. And we tell that to the clients. You got to get the team up to speed early, because everybody's got to do their job. And if they need time to do that job, you got to give them time, right? So we're running not behind, we're running ahead of it. And a lot of people don't realize that. Oh yeah, we're going to get a loan on this, and all of a sudden they run into a snag or something. We actually had an exchange about 1.5 years ago where a bank bailed out of a committed loan to a property when the rates went down quickly. The bank bailed on it, and they called me in a panic. And we weren't even the exchange company on that, but they, from referrals and stuff, it was a company out of New York, they called me. And I called several banks that I knew because they wanted to go to a bank, and nobody would touch it. So that's part of the conversation. And that's a unique thing to happen when the rates drop so fast and stuff like that. But to your point, Chris, and everybody on the call, definitely want to be part of that planning as early as possible, okay? Because that way you're not rushing and playing from behind. You're playing ahead of it, being proactive, okay? So that's the time frame. We tell people that a takeaway on how to work the identification period is this. I tell them, if I was doing an exchange, I'm at this about 21 years now, and I can tell you from all those exchanges we've done over the years and all the ones I've been involved in, if I could close on the sale 1 week and the purchase the next, that would be my goal, period. Why would I wait to have income coming in again? I want to line these something like dominoes, right? And the only way to do that is I got to plan way ahead of time and work this with all the variables out there, the market situation, the properties negotiated, the lending amount, if there's loan involved, all that stuff is done early, okay? And that's where, when I said in the beginning of this call, ignorance becomes a problem if somebody doesn't find out about this until closing date. Now we have a compressed. Can we turn around what we do fast? Yes, but we're only one part of it, right? You guys have your stuff you need to do. The market is doing what it's doing, so the realtor has to do that. So, you know, it's really about as early as possible. So one of the takeaways for you guys as well is anybody that you know of that is thinking of selling an investment property, that's when you mention the 1031. Do not wait for anybody else to mention it. Don't think it's the CPA. Don't think it's the realtor. Don't think it's somebody else. If you're helping that client, which is how you have the client to begin with, and there's a trust there, mention it. Okay. If they already know it, like somebody was saying on the call, great. Let's have that conversation early. I spoke with a client yesterday. I spoke with a year ago. They decided not to sell a year ago. They just called me up to review, but they're thinking of selling now. So you never know that seed planted is going to come for you back to you later because you're one of the first to mention that. Okay, I'll get off my soapbox now, but please, we need time, and that's going to buy you time if you mention it early. Okay, so that's kind of what we say. Now, if they can't sell and buy in 1 week, my further recommendation is that I would like them to have something under contract by the 45th day and at least one backup. Okay, what does that mean? Well, that means they have control of a property, because if the rules only require, give me the list on this piece of paper, right? And if they're on none of them under contract, and we pass the 45th day and the seller has the nerve of selling to somebody else, not them, now they're stuck. Because the rules say you got to close on what's on the list or wait to the 181st day to get the funds back. We very rarely have people in that scenario because we're very proactive. We're educating and pushing constantly on this. Okay. So one last thing of that, and then I'll get to the questions. There's rules of identification. You can't just say, I'm going to buy a property in the state of Florida. Okay. The rules are this. If you identify 1, 2, or 3, or up to 3, there's no limitation. So you can identify 1 if you want. I don't like getting 1, but if the closing's imminent and you know it's going to be there, good to go. Like I said before, I recommend a minimum of 2, one under contract, 1 backup. The rules do not require that, but I recommend it. All right. Now, if you're going to put more than 3, then that gets more complicated. You got to keep the list to less than twice what you sold. So if the net sale price is $1 million, you can't put more than $2 million worth of properties on that list if you're going to do more than 3. So let me translate that to a very easy thing to think about. All right. When somebody does an exchange, they're only going to do 1 of 3 things. They're going to buy something larger in dollars, sell at $1 million, buy $1.5 million, $2 million, $3 million, whatever. That's 1. They're going to buy something around the $1 million. It's never going to match to the penny because of closing costs. If it comes a little under, they pay tax on the difference. A little over, they bring the difference. Okay. Or the third option is diversify. As we said before on one of the questions here, buy more than 1. All right. They need to get clear on that as early as possible, because that simplifies their focus, simplifies your focus, simplifies the realtor focus. Everybody's focus stays simple, right? And they don't run out of time as much, all right? That also helps them with the identification rules, because if you look at those first 2 scenarios, buying something larger in dollars or the same price, they're only buying 1. If you're only buying 1 property, the maximum on that list is 3. Do not put more than 3 on the list. We'll flag it as a courtesy. We don't have to, but when I see that, or our team sees that, we'll give them a heads up. You know, in fact, on our identification form, we add the dollar amount of the 200% number and put red ink saying, hey, time out, stop and call us. Let's have a conversation again. Most companies don't do that. We do, because I ran into it too many times. Somebody got through there and didn't realize after we talked about it already. Because remember, they don't do this every day. Nobody really does. So to remember all these inner workings of stuff is simple, but it's a lot to remember. So we want to keep it as easy for them as possible. All right. So let me stop and get on to the questions here. And then you guys have anything else, please let me know. Mike says, if there's any outstanding medical liens against the property, think construction bills that are paid upon sale, can those be factored out of the 1031 amount that needs to be commuted? For instance, sell a property for $300K, $100K in construction costs paid to a GC upon sale. Do we only need to roll into the new $200K investment or still $300K? It's funny, just before this call today, I had that scenario actually. So here's how you think about it. Unsecured debt cannot be used to pay off, even if it was against the property. I spent $100,000 fixing the property. It's on my Amex bill or my so and such credit card. The answer is no. Okay. If you paid that, it's boots, taxable money, touch money. However, if that debt is secured against the property in a mortgage or a note that prevents the deed from being transferred, the answer is yes. Okay, it becomes just like any other mortgage amount, a debt amount that we talked about earlier. Okay, so that's kind of how I look at it, and we look at those individually, because again, it's stopping. If it's stopping that sale or that deed from being transferred, that's the key. It's secured to that property, and that's the difference. Doesn't matter what the usage was. All right, kind of think of it like that. All right. Jacqueline says, can you get under contract for new property before closing on the? Yes. So great questions. Think of it this way. Contract dates are irrelevant to a 1031. The only thing that matters is closing dates. Not that they're irrelevant in general, right? But they're irrelevant to us. Okay. Now, proof of funds. You will need that for lenders, right? So we can provide one on our letterhead or one from the bank, whatever you guys want. Okay. If that's a request. We usually do it the same day. We usually turn those around pretty quickly. So, but that deposits, If somebody needs a deposit to hold a contract, and let's say you got a contract because you figured out, all right, I'm going to buy and sell at the same time. That means I'm going to get the property under contract to buy before the sale closes, which is what I'm recommending anyway. Well, where are the funds? Well, you got to use your own funds because the sale didn't close yet. Okay. So that's no problem. And then once the fund are into the exchange account, meaning the sale closed, we can replace that deposit to the escrow agent. Okay. Unless the closing of the purchase is imminent, then we won't do that. We'll just fund it at closing and they get it back from the closing agent. Okay, it's basically replacing that deposit. So the 1030, you always want the 1031 account to pay the bills first when it makes sense to. Okay, if you're putting money in anyway because you're buying something more, then it doesn't make sense for us to replace it. You know, because then we're moving money too many times. There's no reason to do that. If they want us to, we'll do it. But I usually say, you know, it's 6 or half dozen at that point. Okay, but just keep that in mind on that. Same thing on a loan amount. If there's an approval process, sometimes people go for loans that are non-investor loans for an investment property. You guys ever run into that before? I don't see everybody's face, but I'm sure you did. Okay. The 1031 is not a police of that usage of the money, but I caution our clients to not doing that. It might be in the tune of fraud for lending. I don't know. I'm not a lender, but if you suggest that that's the case, we had one say that, well, the developer that we're buying the property in will not allow us to rent the property for the first year, so they don't want to know this is a 1031. I said, well, we're kind of already involved in that, right? They're going to find out that because we're sending the funds, you know, and if you're willing to abide by their rules and do whatever you do as far as the rental proof to the IRS, that's on you. Right. So we tell people when they do that, I caution them not to do that. All right. Even though they can get a better deal on a residential use or a primary use property, I caution them not to do that. Okay. So I'll stop right there. I mean, it's a lot to cover. Again, this is just a basic overview, but you have any, you guys have been great, by the way. Thank you for the questions. If there's any other questions or follow-up or points that I can clarify for anybody. I assume you can still hear me.
Yeah, we got you. We just got one in actually. So
Yeah,
Mike
I
asked the
got you.
question. Yeah.
No problem. Mike says, can you roll the 1031 into a purchase of a new construction investment on vacant land? Yes. Okay. The only thing is, if the land is not worth the same value yet, because it needs to be improved, then remember, you still have to get all of it done within 180 days of the sale closing. In that case, you can do what's called a construction exchange. Okay, it's more of the advanced stuff where we take title for you. We'll form an LLC, take title as your agent to hold that title. And then the balance of the exchange funds can be used as your own construction draw for yourself. But the battle is getting the capital improvements into that property before the 180-day expires. So usually that construction exchanges are tougher. They're usually not a full construction because there's not enough time to get it done within 180 typically. All right, Jose, you had your hand up, Jose?
Yes, I have a question. Can
Yeah.
you do 1031 exchange, let's say, once you sell a property to invest into a REIT or some sort of thing like that?
Sure, great question. A REIT, no, but something similar, a DST, yes. And the reason why a REIT is no is because it's not real property. You're buying a stock in a company that owns real property. It's not the same. But a DST, which is Delaware Statutory Trust, where a company buys a portfolio of properties, let's say like an Inland Securities or like a Cantor Fitzgerald, they'll buy a portfolio of properties in the same asset class, like a bunch of multifamilies or self-storage facilities or BJ wholesale clubs, Amazon distribution facilities, stuff like that. And they put it under the ownership of a Delaware Statutory Trust. It's a specific trust that allows them to get approval from the SEC to sell it to accredited investors. And they sell pieces of the trust, usually at a minimum of $100,000 in to buy. And you can, because they consider that purchase of that percentage of that trust as real property. Okay, it's a long answer, but yes on that. As long as it's real property, yes. And percentage of real property, yes, as well. Okay.
Understood. And I think you might have responded to this. I just want to clarify. Let's say that you sell investment property, a single family, and then you want to move into, I don't know, retail space or warehouses. Is that possible?
Yeah. Yeah, as long as the usage is the same as an investment, which that would be, right? And you're not flipping it, yes, it doesn't matter. You know, that's the creative part of this, is that you can sell land and buy commercial, commercial to residential, residential commercial. It doesn't really matter the type. The type is irrelevant to the 1031. It's the usage, as we said before, and the funds, that you don't touch money. Now, in some cases, as I kind of mentioned this before, some cases, it's okay for them to touch money. Okay, I'll give you two examples, one with a loan and one without. We still have some time. So let's say they want 20 grand out of the transaction because they want to pay off credit cards or travel or do something with it. And they talk to their CPA and they say, you know what, paying tax on 20 grand versus paying tax on 100, which is what the gain would be, let's say in that scenario, is a good financial decision because they get the best of both worlds. A better answer might be where the lender comes in and says, I'll tell you what, why don't you leave it all in the exchange? Don't take anything out, and then pull it out with an equity line after the fact. Going back to the same conversation we had before, cost of the taxes on the 10, 20 grand, whatever it is, or 100 grand versus the cost of the loan. Run the numbers. And I can tell you when I talk with clients about that, most of the time you see the light bulb going in, like, I didn't think of that, right? And some of them don't want a loan no matter what. I don't have any loans on my property, whatever. I said, okay, I get you, but you got to at least look at it. And if it's a no, it's a no. It's okay. I don't push more than twice. I just explain it to them because I just want them to know their options, you know, and not push it off because they didn't think of it before. I'd rather explain it to them. And that's kind of how to think about it too. In fact, we do a guide and engagement letter before we do an exchange with somebody. It's about 2.5 pages, explains the entire process in writing. And in the questions we ask them, we say, do you want cash at closing? Let us know. Okay, you'll pay tax on it, but that's a strategy, right? When is your closing date? If you know, let us know so we can start coordinating. And are you subject to FRPTA? All right, so one last thing, I'll just stop on FRPTA. If you guys know what FRPTA is, right? Foreign investor holdback, or do we need to cover that, Mike, do you think, for this group or no? I'm going to cover it. He's not sure.
Yeah, we got time. Let's cover it.
Okay, so
Yeah, Drew, I would definitely touch on it briefly because I know I certainly get a ton of FERPTA questions, and
yeah,
I think it's very relevant.
perfect. Yeah, I just got 2 this morning. So FRPTA, I forget the acronym, Foreign Investment Real Estate Tax Act or something. I always forget the thing. It's back from 1980s. What that says is the IRS wants a foreign national to make sure their taxes are paid before they leave the country. I mean, oversimplifying it, but that's the case. So a 1031 can, anybody can use a 1031, whether you're a citizen or not, first of all, okay? It's not a citizen-only thing. It's a tax code thing. So in order to take advantage of it, you have to be part of the tax code. You have to file taxes. You have to be a taxpayer. You can't get a credit of a system you're not part of, okay? So if a foreign national owns a property and they are not paying taxes, they're going to be subject to this FRPTA, which means it says to the, and James, you guys are right with this too. They're usually the title company is going to hold that funds, right? They're saying they require the buyer or the buyer's group, if you will, to hold back 15% gross of the transaction. So on $1 million, that's 150 grand. Okay.
And just to chime in on that, we as a title agent have to withhold that 15% based on the contract price, not the net proceeds. That's a big shock to a lot of sellers. So just a point of clarification.
Yeah, exactly. Thanks, James. And usually, because they put the buyer's side of it on the hook, because the seller's gone. Seller could take the money and go back to their country, let's say, okay? Now, here's the crazy thing about that. People think, well, when I do a 1031, I'm not going to pay the tax, so it's not subject to me. I go, hold on, just think about it through a second. What if you start the exchange, it doesn't finish? Okay? They still want that money, right? So they're not going to release it. And I think, James, you have 20 days to get it to the IRS once you receive it, something like that, unless it's changed.
Yes, and what I always advise my FERPTA clients, and I have many of them, whenever we get under contract, I like Drew ask some initial questions. FERPTA being an initial question should be on the contract, but if it's not, I get that up front. The CPA or a third-party service such as FERPTA Solutions can assist with the property owner seller filing what's called a withholding certificate. As long as you file that withholding certificate, it's a simple form to the IRS. If you file that by closing day, and I get a copy of that for my records, I, as the closing agent, do not have to remit that withholding to the IRS. I'm permitted to hold those funds in my trust account, which is much easier for you to get that back, the seller to get it back upon the IRS's ultimate determination.
Yeah, and let me explain how that impacts the 1031.
Okay.
You guys still there? It froze.
I think so, Drew. Everybody looks logged in.
Hello?
I can hear you.
You guys there?
Yep, Drew.
Hey, guys, you there?
There you are.
The
Yeah.
internet-
Yep, we can
And
hear
I'm-
you. We
Thank
can
you.
hear you.
Sorry about that. My internet just went for a second. So, and I'm directly connected. So sorry about that. All right. But James brings up a really good point. Let me show you how it impacts the 1031 though. Going back to the net sale price, right? Let's use our $1 million example. If you sell it at net million, you got to reinvest the million. If they're holding back 150,000 of that in this scenario, that exchange is going to be short 150. You can't say, well, it's not my fault because they're holding it. No, you're still responsible to not pay the taxes, right? So if you can't get that withholding certificate in time, because it does take time to get that, then you have two options. And one of them is get that purchase closing before 20 days, which is kind of a rush, but doesn't always happen. Two, you have to fund the 150 yourself because the exchange account now is short 150. So the client would have to put the 150 in, send it to the exchange account, because you can always, that's another takeaway, you can always add funds to an exchange account. Some people don't want to get as much mortgage on the next one, let's say, so they want to offset it with cash. Most don't do that, but if they want to, they can. You can always add cash. Or let's say they're buying something larger. They can always add cash, right? So if that's the case, they'd have to add the 150K to the exchange account before the sale closes, because we have to be able to fund that in time for the purchase to close. I mean, the purchase closing. Okay, that a lot of times could kill the 1031 because who has a 15% laying around like that? Some people do. I don't, decide one way or another. They have to tell me if they have it, but that's a shocker they're not realizing. That's why we started asking that up front, because I don't want them to get into the exchange and realize, well, wait a minute, I can't, we're not able to do that. We're not ready to do that. We didn't expect it. So then the next question would be, try to get that sale and purchase lined up within a week if you can. If you can, great. If you can't, you can't. So that's
just to chime in on that, and not that that's incorrect by any means, but even if you do line up the replacement purchase very shortly after closing, on the initial closing where the seller is looking to reinvest, the amount that I have to withhold as the closing agent, that 15% of contract price, I withhold that even if the seller timely files that withholding certificate to the IRS. The way it works is CPA or third-party company files that form, IRS gets a copy. It's pretty much saying, hey, I don't actually owe 15%. I only owe X because this is my cost basis. This is what my true sale price is. And it boils down the true tax liability of what they're claiming is owed. IRS reviews that, and upon reviewing the form and the supporting financials, they'll issue a determination letter saying, okay, we agree with you. You don't owe 15% of $1 million. You only owe, which would be the 150K, you only owe 30K, which obviously is much better. I'm making up numbers, obviously, but the property owner seller then will essentially remit a copy of the IRS determination letter to me saying, hey, I know you've got 150 grand of my money, my proceeds held back. Here's the letter saying I only owe 30. So I remit the 30 directly to the IRS, and I give the balance of the 120 to the seller. Now that often will take anywhere from 6 to 12 months in my experience. So I literally just released probably a month or two ago a 300 grand check to a client. It was obviously a big closing, big holdback, but I remitted a 300 grand check to him that I had held in my account for 14 months. So just to give you some idea, these aren't necessarily, oh, I lined up my replacement closing in a month. That's fine. But the IRS is not making their determination in a month from my experience.
Right.
And I can't release funds until an official IRS determination, because then I'm on the hook as the withholding agent for that. So I have to really, I've had people barking at me sometimes 9 months later saying, oh, where's my 100 grand, 50 grand that's in your account? And I have to tell them, listen, it's in the hands of the IRS. Your money's safe in my account. It's earmarked. It's not going anywhere. It's in a trust account, with your name on it. But until that IRS makes that determination of your tax liability, those funds are in my account. So just something to keep in mind.
And I would say that is better than when you have to send it to the IRS and get it back from them.
Yeah. Good luck getting somebody on the phone in the IRS saying I need 100 grand. So
I
always recommend filing that form timely before closing, and getting hold of me in my office to get your money is much easier than the IRS.
Right. I mean, they're quick to take it, a little slow to get it back.
They don't want to give it back, but
Exactly.
I personally have to log off. I don't know if we're done here, but
Yeah.
Drew, thanks again. Super informative as always. Mike, thanks for letting us present
Hey,
today.
I appreciate that.
I know
Yeah,
Drew, everybody.
Drew put his information on the chat, so copy down that information. We'll also get the list out to Butler Title, and they'll be in contact. If you need more information, please go through Butler Title. They can get you in touch with Drew and coordinate everything that needs to be done. Fantastic talk, gentlemen. I appreciate that. We got to do this again. I mean, there was a ton of interest, obviously a lot of questions. So we really appreciate that. Someone messaged and asked about recording. Yes, we're recording it. And we will send that out and get you in touch with the people that you need to. So thank you all for your time today. Thank you, Butler Title. Thank you, Drew. Appreciate the conversation. And like I said, let's do that again soon.
Thanks all.
Thank you so
Appreciate it. Thanks,
much.
Mike.
Thanks.
Everyone have a great day.
Good
Bye,
day,
guys.
everybody.